Good morning and good afternoon, everyone. Thank you so much for joining us today for our workshop, the Founders First Capital Partners Workshop, co-hosted by WPO, Fearless Female Funding, Pathways to Success in the Male-Dominated World of Capital. We are so excited to have you all with us today to learn from these amazing women in the financial space. And we'll kick it off with just a couple little housekeeping items. Please utilize the chat box for any questions you have. Attendees, please leave your mics muted, except for during the Q&A section, which will open up at the end of each of our 3 sections, as well as utilizing your mics during our breakout rooms at the end of our workshop today. And with that, I will hand it over to Camille to introduce herself and talk a little bit about why we're here.
Hi, everyone. I'm so happy to be here. I'm Camille Burns. I'm the CEO of the Women Presidents Organization, and I'm thrilled to welcome you all to today's webinar. As Tracy said, it's Fearless Female Funding, Pathways to Success in the Male-Dominated World of Capital. And today's session is going to focus on 2 main parts. First, it's going to be how to gain mastery of the 3 most common capital strategies. And then we're going to hear from both funders and funded companies. So to give a bit of background, at the WPO conferences in 2021 and 2022, we held roundtable discussions with members of the WPO who are women of color to discuss what are the greatest challenges and how could WPO be of greater support. And one of the themes that kept coming up was access to capital and the challenge that all women business owners have with accessing capital, but it's especially challenging for women of color. And so out of the session in 2022, we started an ad hoc committee, and this committee is now led by Kim Folsom. She's the founder of First Capital Partners and a WPO member, and you'll hear from her shortly. And the committee is comprised of a number of WPO members, some funders, and some of our sponsors in the financial services. Our first step was to conduct a survey of our membership. And while we found that capital and accessing capital was a challenge for many of our members, the level of knowledge and experience differed dramatically throughout the membership. So to tackle the needs of the members and meet most of our members where they are, the committee has focused on 4 objectives. First, it's training and education about funding options and readiness requirements to acquire growth funding. Second, it's partnering with various organizations, including our sponsors, that provide funding and expertise to help meet the funding requirements of our WPO members. Third, it's to partner with various organizations, including our sponsors, that provide investment products and expertise to help the education of WPO members and inform members of potential opportunities. And lastly, it's leveraging the experience and outcomes of WPO members, especially those in Platinum and Zenith chapters that have been successful. So today's program is designed to tackle all 4 of these objectives. Now, I want to get right into it because we've got a lot of program ahead. So I will right now hand it over to our MC. I am so pleased that Donna Hegdal, she is the CEO of Trans Synergy Group, and she is the chapter chair of 2 WPO chapters in Dallas, is going to be our mistress of ceremonies today. Donna?
Thank you, Camille, and I look forward to talking with all of you for the next hour or 2. So today's workshop consists of 2 parts, as Camille said. The first is a series of panel discussions with funding experts and women-led companies that have successfully funded growth for their companies. The second part of the workshop then is designed to give you an opportunity to meet with these funders and the funded companies and to share your story about your business and your funding needs. The funding pathway discussions won't end today. At the conclusion, you'll get some additional resources and future activities that you can work on. So there's more to come. So give you a little bit of context about today. Women and people of color are starting companies faster than the national average. But for many, because of the fact that access to the right capital and networks, scale has been a challenge for them. However, there are some new approaches, new funding options, and greater diversity of fund managers, and they are working to address the gap in funding. But first, let's look at these 7 funding options that women are using today to fund the growth of their business. depending on the type and the scale of their company. So first of all, grants, that's the first one. Provide non-dilutive capital to support targeted fundings. Next, bank loans. Most commonly sought, they provide funding based on credit profile and collateral. You'll learn more about this one. Fintech merchant financing. It's the easiest to access and the most expensive source of funding. Next, alternative capital, revenue-based financing. This provides asset-light companies with predictable revenues access to both fast and non-dilutive capital at a moderate cost. Angel financing. High net worth investors will purchase interests in companies they believe will have the potential for high growth. Usually it's tech and life science. Crowdfunding. Consumer product companies will raise funding from crowd or peers for fund expansion using platforms like WeFunder or Kickstarter. Venture capital and private equity. Large investments in core tech and life science at the highest cost that result in a sizable exit. So now we're going to go ahead and start with our first workshop today. And we're going to have 3 funding options and how to master these things that are used to fund growth in women-led businesses. So we'll talk about traditional debt financing, alternative capital, revenue-based financing, and venture capital. We'll start this discussion by bringing up to the stage our traditional debt financing panel. So join me in welcoming Daniel Schwimmer of JP Morgan Chase, also Ann Z of Holistic Institute of Health and Fertility, and Claudia Mirza of Corby Group, a Zenith WPO member. Take it away.
Hello, everyone. Thanks for taking the time to join the webinar, and we'll try and keep it as short and sweet as possible. My name is Danny Schweimer. I work at JP Morgan Chase in our commercial banking division. I sit physically in San Diego. I'm part of a team of about 30 bankers nationwide, and our objective is to support, our initiative rather, is to support women-owned businesses, diverse in ethnicity, and or veteran-owned businesses. A lot of the time that I spend is educating kind of clients and prospective clients on certification, the benefits of why it might make sense to be certified, working with and partnering with networking organizations like the WPO to attend conferences, sponsor conferences, and then most importantly, kind of interacting with entrepreneurs, in this case, women entrepreneurs, to really focus on access to capital. Like mentioned, it is difficult, especially for women business owners, to grow their business because of the lack of support from kind of the broad financial industry. When you're thinking about working at a bank, you would think that there's kind of a prescription or a formula that you could apply to every business when evaluating credit. But the reality is that's just not the case. There isn't a uniform answer, and it's totally situational based off of what the company needs. How are they looking to grow? How have they performed from a financial performance historically? But when you're broadly thinking about what types of debt instruments are available to business owners, I would kind of categorize it into 4 main products. One would be a working capital line of credit. That's typically used if you have a mismatch in your kind of AR and your accounts payable. If you're not collecting, you're not receiving your payments quick enough, but you have to make payments out, you're able to access that working capital line to kind of bridge the working capital gap there. We also have equipment financing. So if you're in manufacturing, there's ways to kind of collateralize the equipment and get access to loans without kind of performance-based analysis on the company side. There's also term loans, and that's typically anywhere from 1 to 3 years. Sometimes you can go out to 3 or 5 years, but that is for, if you're M&A, so you're looking to buy someone, shareholder buyout. We also do owner-occupied real estate. So if you're looking to buy your building, we're able to do that as well. And then, of course, credit card. And credit card is is working capital based as well. So if you think about it, you have a month to spend on your credit card, and then you have 25 extra days to pay it off. So really there's that 55-day cash float there. And so I think those are the broad products that are available to business owners. I think my biggest advice is to know your banker. Don't just know your banker, maybe know 2 or 3 bankers. Your banker should know your business intimately. They should know, be able to tell your story on historical performance, be able to tell your vision on where you're going, and be able to strategize with you on ways to access capital to kind of fund that growth. If it's our job to be advocates for our clients, particularly when it comes to underwriting. Now, when you think about like, how does a bank look at your company? I think it's broad. This is back of the envelope, right? But you can broadly think about it as based off of your revenue size, particularly in JP Morgan's case. If you are a company that has not been in business for more than 3 years, or has not had consistent positive financial performance, more often than not, we are going to rely on the business's financials first as our primary source of repayment. But secondarily, and most importantly in that instance, we'll be looking at the personal guarantee of the owner, the founder. And that does have its drawbacks, particularly if the founder doesn't have great credit history or doesn't have kind of past performance of repayment. But that typically is required if your company is early on in the life cycle, or it has kind of unstable trends. The larger companies, or if the larger companies in revenue size, or or those that have had stable performance, what we typically look at is more of a corporate guarantee. So all of the risk is at the corporation level. And again, this is all back of the envelope, but the analysis that the bank would do is you provide your financial statements, right? And we would look at your collateral coverage. So what do you have in accounts receivable? What do you have in inventory? And there's a formula that's applied as to what we can extend, the amount that we can extend based off of those numbers. And, happy to circle up if anyone has questions on the specificity of what the percentages are. But again, it's all about, I'll go back to kind of just knowing your banker and making sure that they can advocate for you. As your business grows, it's really on you to professionalize your business. I have a lot of clients that, started at 3 million, did 13 million, and then are now doing 90 million in revenue 3 years later. And they still have a team of 4. The woman founder, wears many hats. She's the amazing salesperson, but she's not really the finance person. And as your company grows and scales, it's on you to kind of professionalize that team behind you, and to make sure that you're able to provide financial statements that banks require as you grow and as you scale. So I hope that's helpful. Again, I think my contact information is in the deck, but happy to be a resource and a second set of eyes and connector of all things if needed. Now I am going to turn it over to, oh gosh, who's next? I don't have my
And Z.
And Z. I'm going to turn it over to you to kind of talk about your case study.
Okay, thank you, everyone. It's actually a real honor to be able to have this conversation with you today. I am in Canada, and the reason why I mention that is because I think that sort of changes the landscape of this conversation a little bit. I'm not sure if we have any other Canadians here with us, but definitely the funding sources here in Canada are far more conservative and a little bit harder to get than I believe that they are in the United States. My story that I'll go through very quickly is about getting traditional loan from the bank. And I'll tell you a little bit about who I am. I'm a doctor of acupuncture and traditional Chinese medicine. I have 2 integrated clinics, with over 4 dozen staff. We have 9 different therapy types, and we niche in infertility, prenatal, postnatal care. And I opened the first clinic back in 2011 and the second one in 2013. Where my story ties in here is back in 2019, because we all remember the financial sort of crisis that we went through a few years ago. In 2019, it became very clear that I needed to relocate my firstborn, my first clinic. And so I began that journey. I signed a tentative lease, and then COVID hit. And 3 years later, as I was looking for capital expansion funding to move us to this brand new, shiny, brand new, amazing location, I actually had a lot of challenges trying to obtain that funding. Where I managed to finally get that funding from was BDC, which stands for Business Development Bank of Canada. And what makes BDC a little bit different from our traditional 5, big top banks here in Canada is that BDC is government, it's government funded, but they have a mandate to support the entrepreneur. But as I said, it was challenging to get loans from the other banks, but I got a loan through BDC. And to back up what Danielle just said, and if there's anything any piece of advice I can leave you with, it's because in 2018, I actually, just through happenstance, began to sort of connect with a representative from BDC. And we maintained connection over the years. And she knows my story. She knows how important the work it is that we do. And because of that, when I finally had that conversation with her at the beginning of this year, she sat down with me and she said, we are more than willing to work with you. Let's try and figure this out. So to reiterate, the best piece of advice I can leave is please, please, please do the legwork, form those relationships, because they definitely can be very beneficial in the end. So thanks, everyone.
So Claudia, you're next.
Hi, I am so happy to be here. Thank you for the opportunity. Camille, Danielle, and all of you ladies. I love you to death. And I was saying last week that the woman that I'm today is because you make me that way. I hope it's a good thing, but I am so grateful to the WPO and all the love and support that they have given me throughout the years. I want to say that our story. So I started a group of companies called Corby, and recently we acquired a technology company that does integration and workflow automation. And so the traditional service company has been a language and technology company. So whenever you are looking at health insurance companies, hospitals, and all the telecommunications that goes in to multilingual audiences, we have the telephony that goes behind. Developing infrastructure, and mainly for service businesses, is quite expensive. And really capitalizing that has been really a struggle. And also making sure that we can reflect that in our financials. So the story here is that I had traditional banking relationships for a while. I am very grateful to our sponsors because I had been doing business with them. However, recently, and it was not long ago, I had to even use Kim and go to Kim and approach her and ask her these difficult questions, because one of the main recommendations is that it's important to have great relationship with the banks, that they know your character, that they know the type of person, that they know your financials, that you are proactively, if you don't do business with them now, you might do business with them in the future. Also, banks might have different appetites at different times. So one of the things is also that I think is very important is to have a good relationship with an independent, also investment banker, that they can also do surveillance of the field to understand who could have the appetite to finance you or to provide you loans or lines of credit at that time. Another thing that I want to say is that be careful with your own partnerships, and make sure that you have bylaws that really protect your lending relationships. I just want to tell you something highly delicate and confidential, but I think it's very important for us business owners and female business owners to make sure that we protect ourselves and as our own bylaws with our partners. I had a situation where my partner decided to cancel the line of credit with the bank and just say, I am not going to continue. So I think it would be very important to contractually or bylaws address that and make sure that there are ways to protect yourself and to make sure that your partners, and if they are large business partners, that they really commit to making sure that the lines of credit are guaranteed. The other thing that I want to say is that I just want to flying or running a business is like flying a plane, and think it's a commercial plane. You have a bunch of passengers and you need to make sure that the ride is smooth for the passengers, but also for the bankers. And one of the mistakes that we have made in the past is just this rocky financials and unpredictable trends, things getting out of control, turbulence, keep flying to the turbulence and really not paying attention. So one of the things that I am doing is making sure that I have some good co-pilots that are telling me, okay, there is turbulence ahead. We need to make sure that we change the path, but also make sure that we have the right profitability. Really, it's very difficult to go and explain banks and traditional banks, all these fluctuations and all these crazy moves or movement in your financials. So try to make sure that you are flying a commercial plane where the passengers and all the stakeholders have a smooth ride. But I cannot emphasize enough about how much Kim and has helped me introducing me and to amazing people that had been supporting me through this moment and the transition. But I am working a lot with these commercial bankers, and I cannot emphasize enough about the importance of the profitability in your business and making sure that it is a predictable business. So that's my perspective.
Thanks, Claudia. Song, are you going to lead us in some questions?
Yes, I am. Are there any questions that anyone has? Feel free to put that on the chat or come off mute to ask your questions.
And then Song, I have a couple of questions. So for venture capital, how long does the process take? Or sorry, not venture capital. Sorry. With interest rates being as they are, what do you recommend for someone looking for capital?
Is that a question geared towards me or to
our panel?
Danielle, do you want to take this one?
Sure. You're right. We are at historical highs as it pertains to rates. And I think, our house view at JP Morgan is that rates aren't going down anytime soon. That being said, you kind of have to do the cost analysis on the cost of the debt and whether it makes sense. I'll say more often than not, it does. The whole process from, expressing interest and need for credit, depending on what it is. So let's say you just need a working capital line of credit. Like our bank, for example, would collect the financials. We would do our own internal analysis, and it would take, typically we can close within kind of 30 to 45 days. What I'll say is, you're locked in. Technically, the maturity of like a working capital line is more often than not 1 year. And if rates were to nosedive and, go from high 7s to 4 and below, you can always refinance that line, just like you would on any personal credit that you have. You can also do that on the business side too. So that's kind of what we've been advising our clients. You know, probably a year ago, when we knew that we were in a continued rising rate environment, we would also kind of introduce the strategy of maybe locking in a rate now to protect the upside increase of rates. But I'll say kind of, I don't think that rates are going much higher for the next kind of year. I think they'll stay where they are. And then depending on kind of the economic backdrop, depending on inflation numbers, jobless numbers, we could see a decline in the rates. Not sure if that answers your question, but I do think rates are high, and I feel that for business owners. But more often than not, if your objective is to bridge working capital, then you're going to need to do that regardless of where the rate is, and you can refinance it if rates were to decrease.
And if it's okay, I would like to add that from the business owner perspective, there are things that we are doing to kind of help the situation. We are trying to, we have clients that have early payment discounts that are probably cheaper than the actual bank. So that's one of the things that we are doing for early payment discounts. Also, we have seen a significant amount of delay, or our clients also postponing the payment terms. That is also adding a lot of stress to our financials. But I will say that managing, and again, looking at, with that copilot, looking at the future, doing cash forecast and cash analysis, it has really helped us trying to make sure that we have our AR moving in a timely manner. We had clients that decided not to pay for a long time and really giving interesting answers, but I think it's very important just to keep an eye on the AR to avoid that significant amount of expenditures or expenses related to interest. And we can also try to, as much as we possible can, self-finance to avoid those high interest rates.
Are we ready to move on to the next? All right. So now join me in welcoming our next stage, which is the Alternative Capital panel. First of all, we have Kim Folsom of Founders First Capital Partners. She's also a member of my Dallas chapter in Dallas. So we're happy to have you in WPO with us. Tiffany Newhouse of Newhouse Consulting. She's a member of the Bay Area WPO chapter. And then Valerie King-Bailey of Onshore Technology Group, and she's a member in Chicago of WPO. So ladies, we'll let you take it away from there.
Okay. Hi there. Welcome everyone, and thank you to our WPO president and CEO, Camille. Donna, oh my gosh, you're such an angel, guiding what we're doing with the ad hoc committee, not directly, but has provided such a great support to me. And it's WPO has just been an amazing organization. So sharing with you a little, and I want to thank our speakers and our subject matter experts as well. I want to share with you a little bit about my background and some of the passion and interest behind this. So I'm the founder, CEO, chair of Founders First Capital Partners and a WPO member. Founders First is my 7th business. My prior 6 were tech businesses. I've been at this 30 plus years. And my prior 5 of my prior 6 businesses, I raised equity capital. You're going to hear a little bit about that next up. But of my 6 businesses, I successfully sold and exited 3, raised over 30 million of venture. And it was a slog being able to figure out, how to raise money to grow businesses. Like if I could ask our audience to, use your reaction thing to kind of note, have you raised money before to grow your business? That question was asked at the WPO conference at the 50 fastest event, and And when we asked that question before, most people had never raised money to grow their business. But if you're seeking to leverage your business to improve the quality of your life, or to send your kids to college, pay for retirement, buy a house, all of those things, your business is the best asset to allow you to do that, as well as allows you to contribute to your community and in so many ways. But you know, if you're seeking to have a business to allow you to do those things and allow you to do it not just in your lifetime, but in generations behind you, then what you're seeking to do is build a business that is a growth business. And another metric with regards to that growth business is that you're going to be growing north of 30, north of 30% period over period, or 50% period over period, and so on and so forth. Because when you're growing a business that fast and that level of momentum, you have an asset that is such that you can sell it to others. And I mean, there's just so much value that created. And, you know, the most oftentimes way of doing it, not the only times doing it, is with the leveraging other people's capital to help you get to those pieces. You're going to hear today, as you did, about the traditional debt, which I raised plenty of that too. But Danielle, so eloquently shared the requirements of it, and then you heard from our expert business owners that have successfully acquired traditional bank financing. But then you're also going to hear about high growth, the unicorn company growth. But if you're not in either of those, or you're not there now, there's another there, prior to, in the last probably 10 plus years, there's another bucket or area that is needed for capital to help you on that bridge of which way you're seeking to go. So if you say, yeah, I want to grow my business, or I'm seeking to transition my business, then there's that other capital providers to do that. And that's what we do at Founders First. We are what's categorized as an alternative capital provider to help those businesses that are not quite ready for traditional bank financing, nor are they ready for equity financing. We do this in a few different ways, but it's considered either asset-light, non-dilutive, but it's a hybrid between debt and equity. There is, some, predictability of some, you need to have some predictability of your business. Our criteria is not quite the same as a traditional bank, nor is it as an equity provider. So we're looking for businesses that are ideally generating 7 figures, although we will take some high 6-figure businesses. They've generally been in business a couple of years. They have, for us, we focus on businesses that have contracts with customers, so they can either be service or light service-based or tech-enabled or tech businesses. But, a lot of people, have concerns about service-based businesses because you're really reliant on the people. But if you have, a good batch of customers that really, you're adding significant value to them, maybe you're serving corporations or government entities, those are some of the types of businesses that we work with. We look for businesses, again, revenue-based. They're mostly profitable, however, if they have a path to profitability, we also take a look at that as well. We also, as I said, our product offerings are largely a hybrid. And I would also say the way that we work, because we want to be that bridge for these companies, we look to be a growth partner for them, and it's more than just capital. We provide, post-funding advisory support to them. Because there are some people who know where they want to go and they know how to get there, but then there's some people who may have an interest in saying, yeah, I want to do that, but I don't know how to do it, and I don't know people who are doing that. We can provide support to those folks too, and we provide post-funding advisory support. And I would say the other thing that we do is I, being a serial entrepreneur, and having done this a few times and have had some successes as well as some dramas out of this, I've got a 25-year plus playbook that I have built our company around helping folks to leverage and sometimes that's directly by helping to connect people, and sometimes it's just leveraging the network to help make those introductions. But I have had the benefit with Founders First to connect with a variety of network of individuals, and as somebody was telling me earlier today, you can go so much far with a village. And when you look at the amazing opportunity for women-led businesses, and as Camille mentioned at our last meeting, the conference, that we've grown to 4% of women-led businesses are generating over $1 million, and WPO represents the best and the brightest of that group. And so if you are have the perspective that you want to be running a growth business, our goal with this particular initiative and what the information you're sharing is to get to fill that gap as to how to do it. And with that, I'm gonna pause and actually introduce our two of our case study companies. I'm gonna start with Tiffany Newhouse of Newhouse Consulting, and then she'll pass it on to Valerie King Bailey. So with that, Tiffany, take it away.
Hello, everyone. My name's Tiffany Newhouse, and I am here in sunny, smoky, rainy, I don't know, all of that, California, here in the Bay Area near Napa. And excited to be here with you to share a little bit about our story and the opportunity that we've had to work with Founders First and with Kim. And quickly, I met Kim as I am the co-lead of the Diversity, Equity, Inclusion Committee for WPO. WPO is also an amazing organization, proud to be a member as well. And Kim happened to be one of the individuals that was in our breakout group. And this whole idea, as Camille said, of capital as it relates to women of color came up. And so I was able to meet Kimberly that way. And then I had an opportunity with our business as we're trying to grow and scale our company. And we were looking for capital options. I remembered Kimberly and Founders First. And so I reached out to her and we began talking. And so I just wanted to call out, we had options to go both the traditional route as well as to work with Founders First. And we selected to work with Founders First for a couple of reasons. And I think Kimberly highlighted that a few of those, but I just wanted to highlight those as well, just around the coaching, the partnership, Kimberly's playbook, her willingness to roll up her sleeves. She actually meets directly with you on a regular basis to kind of walk you through, see how your business is going. I just felt like it was more relationship based. And so for us, that was kind of like a real differentiator in terms of why we didn't go with Chase, who's also our amazing partner as well, financial partner, but we decided to go with Founders First. And our need for the actual capital was just, growing our business. Also, we have a slow payer. We work with a lot of government entities, and sometimes they're a little slow. So just covering that was really important for us. And then we also saw that we would be very intentional about growing the company. And so we wanted to make sure from an operational perspective that we were poised and positioned for new opportunities that are coming our way. And so with planting those seeds in collaboration with Founders First, the organization is definitely growing. We have some amazing opportunities that we are seeking to close, and we've been able to still continue to do business with that government entity that's a bit of a slow payer. So that was really our journey and our story, and just wanted to share with you that you may have various options, right? You may qualify for, as I said, traditional as well as alternative, but just making sure that you find the right partner and the right relationship that works for you. And I think that's super important. And with that, I will toss it over to Valerie.
All right. Thank you, Tiffany. I apologize in advance if my voice is not straight. I'm just getting over a cold, but thank you guys so much for this opportunity, and welcome everyone. I am Valerie King Bailey, CEO of Onshore Technology Group. We're a technology company based in Chicago, and our total focus is delivering validation solutions for life sciences companies. And validation is simply a very formal way of testing software for life sciences companies. So we work with the likes of Moderna and Pfizer and Philips, some of the bigger companies, and smaller biotechs, nutraceuticals, medical device companies across the globe. I founded Onshore back in 2004, and I started out with a bank loan. And it was a bank loan of $100,000 from BMO Harris Bank. And we didn't need a lot of capital at the beginning to start our business as a technology business. Starting out, basically, I needed a computer and a mouse, essentially. I started out as a, single person doing this, and then added staff gradually. My objective was to grow the company organically originally. So I, on purpose, didn't want to take a lot of funding. But over the years, I've had different types of financing besides bank financing. We did the receivables financing at one point because I too, Tiffany, had a slow payer, and it happened to be a very big company that was paying us over $1 million, but they were painfully slow in terms of paying. So I did revenue-based financing. That helped a little bit. I did on-deck capital and that kind of thing, and we were kind of coasting along. Onshore's history, we've never lost money in the 19 years that we've been in business. So we've been profitable every year. But a funny thing happened in 2020. I was meeting with the Women's Entrepreneurs Institute at DePaul University. I sit on the board, and I was talking about some of the challenges at this board meeting that I was having with funding the software platform that my company develops. We develop a product called Validation Master, and it started to gain a lot of traction, and I was developing it, but I was using operating capital to develop the application. And this individual that I was meeting with, a co-board member, she said, "Hey, I'd like to introduce you to Kim Folsom at Founders First. She would be perfect to help you with." Well, at that time, I had a line of credit with my bank that I've had forever. And again, I was just using operating capital. And I spoke with Kim and was, very intrigued by the program. I had never heard of revenue-based financing. So with my on-deck capital loan that I had at the time when I was speaking to Kim, they were pulling a certain amount of money, regardless of whether my slow customers paid or not. They were still pulling money out of my bank account, and that got to be a little tricky. Well, anyway, after speaking to Kim, she invited me to come to the Founders First workshop. Well, at the workshop, I was absolutely blown away at what I was hearing. Now, keep in mind, I've been to 4 such programs that promise to help women, do business. I was involved in Next One. I was involved in Inner City Capital Connections. I was involved in the Runners Club, on and on. So I had been through these programs. So I didn't have high hopes for it, but I was really kind of blown away. And what blew me away was the women that I was meeting that understood technology. And one of the things about Kim and my advisor is that they really do understand my business. They understand technology, and they understand the unique challenges that I face. None of that I got from the other programs. So that really kind of blew me away. Well, I ended up getting funding for Founders First. And just like Tiffany was saying, I have a long-standing relationship with my bank, and I had been with them, Harris Bank forever. And one of the reasons why I chose the revenue-based financing model is because it follows your revenue. So, if there's a month where you have low revenue, then the payment is lower. If you have a month where you have high revenue, the payment is a bit higher. But the nice thing about it is that it follows your revenue. I barely notice the payments that are going out because they are so compatible with my cash flow. So that was one of the big things that caused me to do it. So back in 2020, I was just kind of coasting along with my organic growth. And then all of a sudden, my phone started ringing off the hook. Clients were socially distanced, and life sciences companies were trying to validate their systems, and they were finding difficulty because they're not in the office. So a lot of them were paper-based. And so people started calling me because they wanted to be automated. That's the system that I sell. So back in 2020, right smack dab in the middle of the pandemic, I got the funding from Founders First to build the platform. That's what the money was used for. It was to build the platform. And since my business was growing, I needed to increase my staffing levels. Well, all of a sudden, fast forward to 2021, I land on the Inc. 5000 list for the first time. Then in 2022, I landed again on the Inc. 5000 list. And then 2023, I moved up 1,200 spots on the Inc. 5000 list, and the story continues. So from my story is to say that Founders First has made an impact on my business is a gross understatement. It has been everything to onshore. The capital came at a pivotal time, not only in the nation's history, but in the history of onshore, because we were right prior to COVID. We were right at the point where we were getting ready to really move our software forward. And then COVID hit. I'd love to tell you there was some great marketing strategy, but it wasn't. The pandemic actually caused us to grow. So right in the middle of the pandemic, we actually doubled the size of the company. So the revenue-based financing has been excellent for me. And as Kim was saying, it's more than just tossing a bunch of dollars over the fence and saying, go for it, have a nice life, call me when you make $1 billion. There were resources that they provided. I absolutely love my coach. I look forward to the meetings when we talk together because she holds my feet to the fire with respect to my goals, but then she, more importantly, tells me what I'm doing wrong and, guides me into different directions. She's offered strategic advice. And sometimes we as entrepreneurs, we think we kind of know everything. And, one of the things that I've learned is that I don't know everything. And they've brought me so much value to onshore. It's been a great relationship. It's been a great ride. The process of getting the revenue-based funding, if you've ever gone for funding before, it's they put you through the ringer in terms of that. They do their due diligence, of course, but it wasn't a difficult process to go through. And here's the other final thing that I'll mention, which was the pivotal reason why I didn't go with my bank or venture capital, if you will, and I went with Founders. I am a WBE, an MBE, and a DBE, women's business, disadvantaged business enterprise, and minority business enterprise. I've been certified since 2004. The certification is really important to me. And the beauty of revenue-based financing is that they don't take a percentage of equity. And that was very important because I need to maintain the percentage ownership in the company to maintain my MBE, DBE, and WBE status. So there are many other reasons that I could give you, but the relationship has been great, and it has really, really helped onshore grow to where we are now. And what the future holds for us is we're attempting to get to the next level, to the 10 million, 15, $20 million mark, where we can kind of move the company forward. I have a client base that has very deep pockets. And now, for the first time in the history of the company, I'm starting to have fun now because I'm able to go after clients and even bigger fish because I have the funding and the backing of Founders First. So that was my journey in a nutshell, and I look forward to your questions.
Song, are you going to lead us in questions and answers?
I sure am. Once again, if anyone has any questions, feel free to either unmute yourself or write that in the chat. But while we're waiting for that, one question I have for the panelists is, what industries would you say are the best fit for revenue-based financing?
I'll take that one. It's those that have the prospects of growth. And it's really, when you think of the needs of the marketplace, it's really, there are growth areas, as you happen a chance to hear the stories of both Tiffany and Valerie. One is in the telecommunications and transportation area, which is Tiffany's company, as well as being able to provide change management and a variety of innovation leadership to her clients. And then Valerie's in the life science areas, but there are a variety of growth industries that provide for that. But then the other side of it is, just as I mentioned before, the business model of the company that is such that you contract with your customers and there's a predictability and repeatability of your revenue, and the business model such that you are able to have gross margins, ideally, 50% or better, minimally, at least 30%.
I'm sorry, Kimberly. I was so focused on talking about Founders First, I forgot to, mention what MPC did as well. So we do help and support organizations through large transformational change. So that could be digital transformation as well as organizational transformation. We're also a Salesforce partner, and we do a lot of work in the innovation space in terms of AI and building out our AI product suite. As well as some work in the ESG space around advisory. So I apologize for not jumping in. I was just really focused on Founders First and the great opportunities they've given us to really grow our business.
All right, we'll turn it back over to Donna.
Okay, so now we're moving on to the next panel, and that is the Venture Capital panel. We have three speakers here: Amy Nelson of Rethink Capital, Ashley Ogidama of Quality Interactions, and Zeynep Ilgas of Cross Ocean Fund, formerly the co-founder of Confirm Bioscience. So I'll let you three take it away, and I'm sorry if I massacred your names.
Thank you, Donna. Hi, everyone. I'm Amy. I'm going to give a brief overview of kind of the venture capital landscape, and then I am going to pass it, I believe, to Zeynep, but if that's wrong, maybe it's Sharice. We will get it done. So briefly, I work for a firm called Rethink Capital Partners. We are an investment management firm across a few different areas, and venture capital is a large piece of our business. And we are what is considered a thematic investor. There are generally sort of two types of venture capitalists: those that invest generally, generalist VCs, who invest in all kinds of businesses, regardless of industry, or thematic investors like us who focus on different subject areas. So we have one fund that's focused on education technology, another one that's focused on food technology and agriculture, and another one that's focused on healthcare, for example. And one of the things that I think is helpful for companies who are seeking venture capital is to understand how venture capitalists think. So if I go out and raise a fund, let's say it's $100 million, which would be a pretty good size venture capital fund, the way that I get paid is every year I take 2% of my total assets under management, and that has to cover all of my expenses. So my team, our diligence, our office, our travel, pretty much everything has to come out of that 2%. And so, you know, that's good money, but it means you're talking about small teams who have to be pretty nimble. And then the way that we really make money is what's called carried interest. So 20% of the fund, after we've returned capital to our investors, 20% of the proceeds above and beyond that go to us. So that's how a venture capitalist is aligned with its investees or portfolio companies. But one thing that's really important is that venture capital is really expensive. So if you are an entrepreneur, you are essentially exchanging a piece of equity or selling equity in your business in exchange for the money that I will give you. And so in order to be willing to do that, you have to think that you have very, very high growth potential. Generally speaking, a venture capitalist is going to underwrite to at least a 5x return, often a 10x return on their capital. And when they're giving you a valuation, that valuation often has really nothing to do with the actual value of your business and what so much as what they think the value of your business could be in the future. And so when you're initially valued by a venture firm, it's going to be based on your growth revenue. So maybe you have $100,000 of revenue, maybe you have $1 million in revenue. Typically, they're going to value you somewhere between 8 and 10x of your revenue. But when you go to actually sell your business, whether that's an IPO or an acquisition, the expectation is that the company is going to be profitable, and you're actually going to get valued more often on your EBITDA or profitability. So over your venture capital journey, which can take 10 years plus, you need to move from probably not being profitable, being valued based on your revenue, to growing into profitability, and then being able to make a return above and beyond that. And so you're really looking at a high velocity business. And so, from a company perspective, first and foremost, venture capitalists are looking for high growth potential. So this means it could be 50+% annually, in some cases 20% month over month type growth, particularly around a Series A. Which means these businesses are often asset light, right? So services businesses can be backed by venture capital, but it's more rare. You're often looking at technology businesses and even more so software businesses are the general types of businesses, but there are plenty of exceptions to that rule. Often companies getting venture backing, particularly in the earliest stages, have some revenue, but it's not actually required. If you are looking at a seed or even a pre-seed deal, and I would understand the landscape of venture capitalists, right? So it's the tiniest piece of the finance equation. There are maybe 2,500 VC funds in the world, give or take, but they tend to be small. They tend to be specialized. And so you really have to understand who is investing in your industry area at your stage. Are you, very early? Or are you looking for growth capital, as well as for companies of your type, whether that's software or services. So there's a lot of education that you need to do up front. But rarely are companies that are venture-backed going to actually be profitable. And then, of course, it's expensive. You're selling a piece of your company, and the venture capitalist is going to set the price. They're going to tell you how much they think that your business is worth at any given point in time. And when you go out, you'll typically have what's called a lead investor that is going to provide most or a lot of the capital in a round. If you're raising $1 million, they may be a $500,000 check, but most of the time they're going to be multiple venture capitalists or venture capitalists sitting alongside angels in a financing round. VCs don't like to go it alone. They have a herd mentality, and they want to see that the lead investor is a high quality investor who understands your business and has a track record of success, ideally. And the other thing to remember is that it's a treadmill. Once you start raising venture, you typically have to continue raising it in order to meet your growth targets over time. And so you need to really understand that this is going to be something that you're committing to for the long haul. And then, you know, every VC is different. They say once you've met one venture capitalist, you've met one venture capitalist. And so I wish I could tell you, you know, the secrets to success. But generally speaking, and we do have some businesses in Mexico. To answer the question in the chat, we do invest globally, although most of our businesses are in the United States. You need to make sure that you're finding someone who's really aligned. So within a venture firm, there's typically going to be a couple of partners, maybe a handful, and then some junior folks who are going to handle diligence and support you. But my biggest piece of advice is to find a partner at a venture firm who really understands your business, understands you. And if you get any kind of weird vibes, that's probably not the right one for you, because this is someone who's going to own a piece of your business for a very long time. And so you want to make sure that it is the right partner for you. I will happily answer questions when we get to that, but I think in the short term, I am going to hand it to Charisse.
Thank you. I want to make sure that everyone can hear me good.
Yes.
Yes, excellent. I'm Charisse Hawkins. I'm the CEO and founder of PageDip. PageDip is a SaaS-based software company, and we're based in Denver, Colorado. I also consider myself a corporate escapee. I might have coined that term. I'm going to claim that I coined that term because I worked in large enterprise companies for a couple of decades before starting my company. We've pretty much gone through the whole gamut of money that we've raised to move our business forward. We began with some friends and family angel funding in the form of a convertible note. We had the benefit of having a grant that we qualified for and were awarded through the state of Colorado to help grow the business at a really critical time when we actually needed to pivot our technology to meet the needs of our customers. And without that grant, I dare say we would have really struggled to be able to make ends meet and continue to move forward. From there, we did get investment through an angel syndicate group. So it is preferred equity, but it was through ASTI Angels, an angel group in the Bay Area. And we have also worked with some income or some capital associated with non-dilutive capital, like we've been talking about in this session. So throughout the time that we've been in business, which is a little over 8 years, we've been through a number of different stages of raising money. And I agree with the statement of once you raise, you really need to understand what track you're going to get on, because it will dictate not only how quickly you can grow and what control you have over your company, but also how you spend your time, because raising money in the preferred equity realm is really a full-time job. It's very time consuming, and so you need to understand how you're going to run the business when you're in that mode. And one of the questions I was asked to answer is why did we raise certain types of capital at what stage, and what was the strategy behind that? And I will say that that we were very opportunistic first and foremost. It was difficult to raise money as a person of color and as a woman, and so I feel like at a certain point I was just looking for what was the right fit. Secondarily to I need cash, and so where's the right place to get that, and what connections do I have? So with that experience in mind, I would say really thinking about your fundraising strategy alongside of your company growth, like literally have a plan where you're mapping them in parallel, and understanding where you will need cash and what is the ideal. Maybe you can't get the ideal partner, but if you did have an ideal partner, what would that look like? And thinking about that proactively. I didn't do that, and I wish that I had. I don't know if I would have necessarily changed the outcome, but certainly keeping that in mind is something that I would highly recommend. And just thinking about how you can be aligned with your investors, whoever they are. And I've found as we've gone through this process, I've been much more selective with who we work with, and someone, a mentor once told me that all money is green, it spends the same, but who you work with in that capital is what differentiates. And we've heard this about Founders First. So how people will support you after the check is written is critical. What types of resources, what can they make available? How can they actually help you grow the business and be more than just cash, but actually advice, connections, access, other opportunities is something that you really, 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 I can't stress enough how important it is to think about the relationship, not the day that you make the deposit in the bank account, but how that relationship will roll out afterwards, how it can move the business, and how it can be used as another type of resource and another growth flywheel for you as you move forward. Happy to answer questions about any of those different processes. We have been at a point where we have not needed to raise money we've been at a close to a break-even place. And, kind of understanding, sometimes people will say, you're not pushing hard enough because you're not in debt and you're not utilizing capital to grow as fast as we'd like to see. That caught me a little bit off guard. But it's something to be aware of how when you raise and how much you raise, how that is perceived by people along with your growth trajectory. In my case, we got very conservative during COVID, and I think that's what allowed us to survive and then thrive afterwards. But just understand that the decisions that you make can be questioned, or you need to be able to explain your strategy to those later on. Again, happy to answer questions, but for now, let's turn over to the other panelist.
Hi, everyone. I'm Zeynep. To see everyone here. I am from San Diego, and I wanted to also thank WPO for inviting us to be on the panel. So I am an immigrant from Turkey, and I came to this country 25 years ago for my master's in business. And always with I always wanted to start my own business, but in Turkey it was a little bit harder in terms of the economy or being a female founder. So came here with my husband for our MBAs. And after we graduated, we actually started our business from the garage. We were two partners. And although I'm in biotech, I didn't have a biotech background to begin with. We saw an opportunity in the marketplace and we just went for it. So we ended up creating health and wellness test kits that you can buy now over the counter in a lot of stores, where you can test your hormones, substance abuse, pregnancy, which is already out there, and all sorts of other things if you want to take charge of your own health. And initially, two founders, no credit history. We didn't even have a social security card when we came here. And with a broken English, which I still have, there was no way for us to raise money. We even had a hard time getting a debit card from a bank as is. So that was never an option for us. So we had to become very, very resourceful in terms of how we're going to start the business, grow the business, and take it from there. So ours was a baby step process, working from the garage. A friend of ours helped us build the internet site, and we learned the market. But in 2008, so I'm fast forwarding to 2008, is when we established Confirm Biosciences. And by then we knew more about the players in the market. We did have a credit history, and we had made a lot of connections, and we were ready to launch our product. And it has been an amazing journey for us. Once I got pregnant for my kids, then is when we moved out from our garage and grew from there. And initially, the way we started to fund our company was on our personal credit cards, and we ended up selling a lot of our products online. So, when you purchase items online, you get the cash in a few days after the purchase, and we were able to negotiate 45, 60 terms payment plan with our vendors. So that really helped us from a cash flow standpoint and working capital standpoint for a while. And as we started growing, is when our capital needs started increasing as well. So once we had a little bit more revenue and a track record, we actually went to our bank and got a line of credit. I ended up never using it, but just having that line of credit gave me a sense of security and just a way to sleep better at night. So from that standpoint, it served its purpose. And over the years, we grew our business. We got certified as a woman-owned business, as a small business, and we're able to get some government contracts using that certification. And our contracts were, with the military, with the different Department of Defense, providing them with substance abuse test kits. And I agree that their payment terms were a little bit slower. And what we ended up doing is get smaller contracts where most of the time they were paying those a little bit faster than the larger contracts. And we were also able to get a lot of accounts through government contractors. So these are private companies, larger companies that are like SAIC that work with the government and have to have small businesses involved in their own contract. So payment would be through those companies, which was much faster. Venture capital, we ended up getting private equity, but venture capital was definitely not in my horizon as we were growing the company because of the equity piece. I didn't want to give up a lot of equity for a smaller valuation. And so for me, it wasn't something I was really interested in. And as we grew the company, we had enough cash flow to fund and fuel our growth. Until we had the opportunity to present to Walmart for retail store distribution. And when we first got our test market with 200 stores, Walmart actually wanted to do a national distribution with us, 5,000 stores. And we asked them to give us 200 stores, just so we can prove ourselves as a vendor. And we didn't tell them this, but serving to 5,000 stores would have been impossible from a cash flow standpoint. So we started with 200 stores, proved our model, 300, 400. We were able to do that with our own money. But once they gave us national distribution is when we needed cash to grow the business. And that's when, and during that process, we were also in the Inc. 5000 recipient list 5 times in a row, best places to work for. So we were blessed with different awards and recognitions. And the word of our company got a little bit more out, that a lot of the PE firms, VC firms started approaching us. By the time we were ready to talk to venture capitalists, we were actually more at the private equity stage firm where we needed capital. We were able to show our financial statements to back that. And, when we were going out there, I heard all these horror stories from former founders saying, how they take over your company and they lay off people and they run their own show. So it was very important to find someone that I can trust and I know and just, help us take it to the next level. So we actually went with a local PE firm, someone I've known for years, and that were specifically funding companies, and their funding the way they were actually reporting to their limited partners, like Amy was saying, of course, they want to have a good exit with their portfolio companies. But some of the things they were also reporting was how many jobs were created, how many employees were educated, is it a good place to work for? What are the benefits the company is offering? So the wellness of the employees was a very important part of how they were reporting to their investors, which was very important to us as well, because we always wanted to take care of our employees. And one of the things we did was we talked to their portfolio companies, the ones that had a good experience, and as well as the ones that didn't have a good experience, that went under. So we got both sides input, and flying colors. That's when we decided to go on a PE firm. We received funding twice from them, and 3 years after the funding, we ended up selling our products in CVS, Rite Aid, Walgreens, all of them. COVID hit, we came out with a COVID test, and then right after that we were acquired. So we had our exit. Now, the takeaways from this is, and this has been mentioned several times, build your good relationships with your bankers, accountant, even printer shop, whoever you have as a vendor. One of the things we did early on was we would always communicate to all of our vendors, and we did a email called love@confirmbiosciences.com that would go to all of our vendors, updating them periodically on achievements, progress, just like an investment letter. And that really kept them up to date. I met with them periodically, so they knew, who was running the company and updates. So that the relationship piece is really, really important, especially when you're in a situation where you're asking for a larger line of credit or extension on your terms. Start with the end in mind. That's another takeaway from me. If I had to start all over again, I would definitely look at where do I want to see this company in 5 years, 6 years, 10 years? Is this something that your kids will take over one day, or you want to be acquired, go public, or just do your thing and then, do it as long as you can? So once you have that end goal in mind, and you have your stakeholders, if you have any at that point, as input, then that makes life so much easier. The minute we decided, you know what, in 5 years we want to be acquired, is when we started the PE, private equity search. And we got organized. I mean, going after private equity is a 3-year process by itself. You have to have a data room where you put all your financials, HR documents, incorporation, customer, vendor agreements. That takes time to do. And so that helped us with the process. By the time we talked to the PE firm, it took us 6 months to get funding and 3 years to be acquired. And that was because we had, all those documentations in place. And build a great team. I mean, your team is what's going to make this go to the next level. So, they always say, hire slow, fire fast. So it is so true. You want to definitely create a team that is diverse, has people from all the sorts of backgrounds, and bring the best out of each other. And, don't be afraid of failures. A lot of doors might be shut sometimes, and that's okay. And we have a community here. I mean, just being here in this panel with all these amazing ladies, this is a community. So ask for help, reach out to each other, ask for mentorship, and stay in touch with each other. And enjoy the ride. And now at Cross Ocean, we have the opportunity to actually fund immigrant and underrepresented founders that are trying to grow their businesses on the technology side and digital health side. Happy to answer questions. Thank you.
Song, do we have any questions, or do we want to move on to the next session?
It's up to everyone. What do you think?
You know what? I think we can entertain a question. I think that this has been, such a rich conversation. This is Kim. Sorry for interrupting here. But we may, I was just actually in the midst of sending a note to Camille. We may be able to surface up and entertain. I know we have a hard stop in like 11 minutes. We may have to be able to, entertain some questions initially, and then work to schedule a part 2 of this, which is the matchmaking, just to give people sufficient time. There was such rich information shared, but that's what I would ask, if that there are some immediate burning questions of the folks in the audience, and then we also have some questions that were surfaced before, that were submitted beforehand, that Tracy has. And then see if we can't schedule these good folks to do a part 2 at sometime in the next 30, 45 days. So with that would be my ask and recommendation. So if there's anybody who has their hands up to ask a question, otherwise maybe Tracy, you can share some of the free questions that we got ahead of time.
Yeah, Song has those questions. So Song, I'll let you go ahead and ask them to the panel.
Yeah, absolutely. So one of the questions that came up was, what are the steps and documents needed for funding through venture capital?
I'll take that. Sorry, I had to let some guys working on my floors out. So typically when you are going out to raise, you're going to first put together a pitch deck, which is going to explain your business, your sort of unique value proposition, where you sit in the marketplace, your growth plans, have a little bit of a pro forma financial model, and kind of what you're looking to raise, like how much money you're looking to raise, and then what are the use of proceeds? What are you actually going to do with that money after you've raised it? Those are kind of the basic things. You can find all sorts of great information online about how to put together a winning pitch deck for a venture capitalist. And then you're also going to need to put together a data room when you go into diligence. And so once you've met with a venture capitalist, they like you, they want to look closer at your business, you give them access to this virtual sort of set of files. It'll typically include in-depth financials, more biographical information about your team, which will also be in the deck. More information about your customers or clients or your source of revenue. So if you have contracts, some of those might be uploaded. Basically whatever information you can provide to validate that you have a real business or a real track record in a prior business, if this is at the concept stage, as well as references and that sort of thing. And then the venture capitalist is going to, if they decide to move forward, they're going to make a series of calls. They're going to go through your financial model. They're going to test it. They're going to change some of your assumptions and see how that changes what they think your business might do. And then ultimately, they will prepare a memo for their own internal investment committee that describes your business, why they're excited about it, what the risks and opportunities are, based on both the information you've provided and what they already know about the market and what they've been able to find outside through back channels or other research that they may have conducted. And that process can take 3 weeks, it can take 3 months. It really depends. Right now, it's taking longer because we're not in the frothy days of 2021. And I always recommend that founders be really, really buttoned up when they go out to raise, know who your top prospects are, know what you're trying to make happen, line it up as quickly as you can, because otherwise the longer it drags out, the more people start to go, why hasn't this company raised exactly? And so a high degree of organization on the part of a founder makes all the difference. Unfortunately, that's something that women tend to be pretty good at.
I know, Amy, you read my mind. One of the other questions was, how long does the process usually take to get funding?
So yeah, it really varies, but 3 weeks would be aggressive and 3 months would probably be typical.
I would follow up that question. This is Kim with, what about first-time founders? What insight would you give to first-time founders seeking to raise equity capital the first time?
Yeah, I mean, first off, it depends on how far along your business is, because if you already have customers and metrics, that's fantastic. Otherwise, the company, the venture firm is going to be reliant upon understanding your personal background and your expertise. And so if you are a first-time founder in an industry that is totally unknown to you, that's going to be really hard. Right? So how can you demonstrate that you have put in the research and the time to understand the problem that you are trying to solve and your unique insight about what the solution to that problem is, and that you really, really understand your customer and that you're building something that people are willing to pay for. But you're gonna be digging really deeply into references and background, particularly for a first-time founder.
And then one thing I would add is, if you're a first-time founder and, you're still building your team, building a board of advisors, and those are going to be people that believe in you, believe in your technology and solution, that will help you when you are building your case, especially if it's a type of technology that you're not familiar with, which was in our case. We had a good board of advisors to back us up because we were not biotech PhDs, yet we are here doing a biotech company. And then another thing I would like to add is that, you know, when you're putting your data room, you know, even adding your press clippings in media, what type of exposure you received, customer testimonials, your financials. But when you are listing your financials, you know, they're going to be looking at your accounts receivable, accounts payable, and, you know, be able to, you want to be able to answer any types of questions. Why are you not getting paid? Or why are you late on your own payments? Those types of questions, you know, you want to be able to answer. Your projections, they're going to be looking at, have you lost a big account? Why did you lose that account? Or you're about to get a new account. When is that going to happen? Do you have a letter of commitment? Do you have a contract if you already have that account? What is it going to cost you to cater to that account? So all sorts of very detailed questions that are going to come up. And one of the things that is also important on your end, that you do your research before you are talking to these types of, you know, investors. What type of companies have they invested in? Has any of their companies gone exit? You know, have they been a successful VC? Has there been anything written about them? So do your research on the type of firm you are talking to. When you are putting together your list, we actually, first-time founder, we are putting together our list. We had a medium list, you know, hot list, and a test list. And the test list was, okay, we're going to start, you know, doing our pitch to this list. If they don't want to talk to us anymore, that's fine if you don't get a second meeting, but at least we'll get some question Q&A. It will help us prep for the, you know, the list that we actually want to pitch to. So I would start with that list before you're going to your hit list, and try to get introductions. It could be through an attorney, accountant, board of advisors are great for introductions, because that will definitely, VCs get a lot of pitches on a daily basis. I would not recommend going online and just doing it through their website. Try to get an introductions, or meet them at a conference if you can.
Right.
Yeah, you just stole one of the things that I was going to really stress, and that is do the research ahead of time. You can also get introductions from the CEOs of companies that they've already invested in. So you really have to enter in through, to be successful, you really have to enter in through a warm introduction, like any kind of sales. You're selling yourself and you're selling the company, you know, to get people interested. So it's not some people say it's just a numbers game, but it's a relationship game, and you really do need to have your ducks in order, your data room in order. But getting those introductions, I don't think I've ever spoken to anyone who got funding where they didn't have a warm introduction, or they just fill out the form in the beginning or answered an email from a low-level advisor. It just doesn't, in my experience, that's not how it really happens.
Yeah, there are a small number of venture firms like Lightship Capital that are focused on diverse founders that are committed to, you know, reading those pitches that come through. And some of them have actually said the only way to pitch me is through my website, but that's like a very small number of groups. And that is really for equity reasons. But I agree, we actually love it when we get referrals from our portfolio founders. That's one of the strongest referrals that we can get. And of course, other venture capitalists. And, you know, we have, because for us, our pipeline is how we live and die. So it's really important that we have the best companies that we see.
We're down to our last 1 minute, and I'm going to mention to you that the Founders First have given you a funding resource guide. That's going to be mailed out to all of you, and it will help you answer a survey to access your funding requirements, some training materials, and then access to a directory of funders. And also, as Kim mentioned, they're going to try and reschedule something that gives you access to some of the funders already that we talked to that we didn't get to meet with. So you'll hear about that as well. Anything else you want to add, Kim or Song?
I just thank you. And, you know, I am certain we will distribute out the copy of this presentation. So rich. I know that we're all super busy business owners, but I also encourage you to share this with your other WPO colleagues and encourage them to take a listen, so they'll be prepared for our next part 2 session where they get a chance to meet the funders and the funded companies. But I want to thank you all. I know you all are so busy, but appreciate you taking the time and sharing your expertise with us, because this is how we're going to grow great, you know, businesses led by women. and inspire the next generation of business owners that are led by women to, have representation in the mid-market and larger businesses by getting that inspiration. We can do it, and we can do it within the support of this great sisterhood. So thank you, everyone, and enjoy the rest of your day.